What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. This is the podcast for real estate investors and small business owners. We help you keep more of your money. Today's episode, we're going to visit another court case that recently came out. So this particular court case deals with one of our favorite deductions, depreciation. And it was released in March of 2025, so pretty recent. This is the case Sherman Derell Smith v. Commissioner. It's Tax Court Memo 2025-24. So this case sort of highlights the importance of proper substantiation and how missing paperwork or poor math and valuations can cost you. So what we're dealing with here is a depreciation deduction gone wrong. So let's dive in and take a look at this case and see what happened. So we have Sherman Smith, that's our taxpayer, California-based taxpayer who he co-owned a rental property in Los Angeles with his brother. So the brother originally bought the home in 2022 with a mortgage from our taxpayer, or a loan that was secured by a mortgage. Now, the brother used this property as his primary residence. Years later, in 2011, our taxpayer took over the loan and his brother transferred a tenant in common interest in the property to the taxpayer, to Sherman Smith. Now, fast forward to 2018. Sherman's return gets flagged for an audit. The IRS sends a notice of deficiency that's translated to "you owe us more taxes." Now, an important note here is the court pointed out that the 2018 tax return, due by April 15th, 2019, but Sherman didn't file and provide the Schedule E with the depreciation deduction until after the IRS contacted him. They even made a comment to the effect of, "We suspect that things would have turned out much differently had this been reported on a timely filed return." So that's important as well. Submitting things late, you really increase your risk of having issues. Now, there are extensions available. In fact, we encourage many of our clients to file an extension, especially if you have K-1s that come in late. There's nothing wrong with an extension. Do a tax projection, make sure you pay what you owe by April 18th, but you have an additional, or April 15th, you have an additional 6 months with an extension to actually file everything and tie it down. But when you're late, in this case, years late, he didn't provide this information until March of 2024. That's where you're going to run into issues. Make sure you get everything in by that extension deadline if you're on extension. If you're not on extension, then it's the typical April deadline or March for S Corps and partnerships. Now, where things went wrong in this case is the IRS denied the depreciation deduction. The court agreed. And the reason being is there was not a clear or precise calculation of the property's basis for depreciation. Now, this started off as a personal asset with the brother living in it as a primary home. It was converted to a rental or an income-producing property in 2017, although we're dealing with the 2018 return. When you convert a personal asset into an income-producing asset, you are required to use the lower of the original cost, or the lower of the adjusted basis, which is typically your original costs reduced by depreciation, if any, or the fair market value. So you use the lower of those two numbers. Now, Sherman, the taxpayer, couldn't accurately determine his adjusted basis because it was originally his brother's property. Then it shifted into some joint ownership with the transfer of tenants in common. Apparently no appraisal or anything was done at that time. So they couldn't figure out how to value this tenancy in common. Things got messy. The IRS would not accept the what they called ballpark guesstimates that the taxpayer came up with. in regards to fair market value, he also tried using the case says he used some online tools available in 2024. My guess is he was using sources like Zillow or some other real estate sites for a ballpark, what they called a guesstimate at the current fair market value. But again, the IRS and the courts were not buying it. So it's really, he lost this deduction because there was a lack of substantiation. So no documentation, no detailed support or credible numbers available. So he got no deduction. So things didn't add up. He couldn't prove that they did. His depreciation deduction was denied. Now, just a quick word on IRS record keeping requirements. So the IRS expects you to be able to prove any numbers you report on your tax return. You should be able to support them in some way. So if you're a landlord or a small business owner, you have a requirement to maintain adequate books and records. That way you can support the numbers on your tax return. So that's if when it comes to a piece of real estate, like in this, you need to document the property's basis. If it's converted, you're going to need the basis and the fair market value at the time of conversion. You'll need depreciation schedules, proof of rental use, like leases. Keep all your documentation related to your income producing assets, or any number on your tax return for that matter. So real estate investing isn't just passive income, it is a business, so you need to treat it like one. Now, some key takeaways for you is know your numbers. You acquire property in a weird way, like a transfer of a tenant and common interest from a sibling, as in this case. Make sure you determine up front and figure out how to calculate your basis and save your records and documentation to show how you exactly did that. Don't wait until you're under audit by the IRS and try to do it later, oftentimes many years later. On fair market value, don't guess. Don't just look it up on Zillow. Get an appraisal or some sort of valuation from a certified source. And claim it the first time on an originally filed return. Now, it's fine if you need to amend, you missed something. Amendments are perfectly fine, but don't try to slip things in later after you're under IRS examination. And just make sure you document everything. Best way to show your work, best way to prove a deduction is to show your support in the work and how you came up with it. And again, the conversions, always remember lower of fair market value or that adjusted basis. This caused people problems shortly after the 2008 crisis, where people had a home they were living in, they wanted to sell it, the market had tanked, they couldn't sell it. They thought, well, we're going to hang on to it and treat it as a rental. And those depreciation deductions at that time, when you convert it to a rental, you had to use the lower fair market value, even though the original cost was higher. So that tripped a lot of people up back then as well. So this case, in short, is really just kind of the perfect storm of good intentions, but bad documentation. And that's going to lose every time, especially if you're under examination by the IRS and you take it to court. You've got to have proof and substantiation for what you're claiming. So that's it for this case. Pretty short, quick, easy one. They lost the deduction because they couldn't prove how they calculated it. They had no proper documentation. One last thing I want to touch on is a quick Q&A. We had a question come in from one of our business owners. So it says, my business is a C corporation, and we recently set up a new subsidiary LLC. So the C Corp owns the LLC, and we're wondering, how do we report this on our taxes? Do we need to file a separate tax return for this LLC? And the answer is no, you don't. It's a wholly owned subsidiary LLC. So that LLC's activities are going to roll up onto the tax return of the entity that owns it, in this case, the C Corporation. So you report all of that activity on the same tax return. Now, if the corporation owned part of it and then there was another partner involved, there would be a separate partnership filing. But in this case, it's a single member LLC. It's a disregarded entity, similar to a single member LLC being that's owned by you personally, is reported on your personal tax return. The same goes in the business. Same applies to the business returns, such as a C corporation. Now, you may want to track that activity separately in your books, and there's ways to do that. For example, if you're using QuickBooks, you can use something like classes and categorize all the LLC's activities in a particular class. But for the tax reporting, that activity is going to roll up onto the main tax return. So that about does it today. Thanks for listening to another episode of the CPA Zone. If you found value in this episode, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.